Hello guys, welcome back to the channel, and let's now get in more details on the accounting side that we have been trying to understand. So in our previous slides we have understood saying how a journal entry is passed, and from the journal entry continues its journey from the journal book till the trial balance. So now let's understand like what is the future course of action for that particular journal entry. So after the trial balance is prepared, so what is the next level? So when the trial balance is complete and the next level of accounting work for that particular journal entry will be called as the final accounts or the preparation of the final accounts. Okay, so and this involves preparing your trading account, preparing your profit and loss account, and preparation of balance sheet. So in our initial sessions where we have understood how the transaction flows from a journal book to the balance sheet. So we have covered the first part of in the earlier sessions, and now we are trying to cover the rest part of the transaction that will flow from starting to the leaf level of your journal entry till the destination of its balance sheet. Okay, so now here the trading account, the one point that we really need to keep in mind that the profit and loss account and trading account are really drawn for a specific period of time. Okay, say for example from 1st January to 31st December, or 1st April to 31st March. Basically these are like for a set period, and in general that will be for a financial year. Okay, while as your balance sheet is always pulled or drawn on a particular date, so that's why we call it as balance sheet as on date. We do not really draw a balance sheet for a particular period of time, unlike your trading account and profit and loss account. So before going into more details of this trading account, profit and loss account, and balance sheet, I just want to brush up few points from your previous sessions, especially on the trial balance, because that becomes your starting point to enter into more details of your trading account and profit and loss account. The first point that I want to highlight is the trial balance contains all of the account balances from your ledger. So if you remember, when we completed our ledger accounts, we said these will be moving into your trial balance, and in the trial balance we will be summarizing the balances of the ledger. So that is what we are again re-emphasizing on this point. And all the debit balances usually represents either the assets or expenses. If you remember on our first session when we were talking about the concepts of accounting, that's when we were talking about capital plus liabilities equal to asset, right? So this relates back to that concept. So if you let's keep in mind always that the accounting is always based on the initial principles that we have understood and the golden rules. If you are thorough with these two things, you are really very good with your accounts. Okay, so now what is the next point? So that says that credit balances usually represents either income or liabilities. Again, going back to the same equation, capital plus liabilities equal to assets, or assets equal to capital plus liabilities. Now expenses and incomes are shown in the trading and P&L account in both, while as our assets and liabilities will be shown in your balance sheet. Okay, so this again going back to the same aspects of equation that we had, capital plus liabilities equal to assets. Now let's go and understand what is this trading account, and how does it really appear, what are the details that we need to understand before we get into more details, or before we start our journey towards the profit and loss account and the balance sheet. Okay, and the objective of drawing a trading account is to understand the gross profit or loss. Okay, now what is this gross profit or loss? So gross profit is nothing but it's a sales proceeds minus cost of goods sold. So when you have your sale proceeds higher than your cost of goods sold, that means you are having a gross profit. But when you are having your cost of goods higher than the sales proceeds, or basically the revenue, then you are ending up with a gross loss. So what is the emphasis of drawing a trading account to understand the gross profit and gross loss? Why can't I directly go and say that profit and loss? Because we in general understand, no, okay, I've made profit or I've made loss. So but why do we say gross profit and gross loss? Okay, to understand more in details, let's see what all specific things that we need to consider uh, to ascertain our gross profit and gross loss before we finalize our net profit or net loss. So that's why in accounting parlance we always consider gross profit and or the gross margin, and net profit and net margin. Okay, so as usual, like in the trading account as well, we will have, say, accounting, again I'm going back to my old concepts of your debit equal to credit. Every aspect will have, every transaction will have two aspects, the debit side and the credit side. So considering all those points, here again I'm coming back to emphasizing the same point of having debit and credit. Okay, on your debit side of a trading account, we normally take, normally is what I'm saying, there might be additional line items, but in general these are the items that we consider for your debit side as well as your credit side. The opening stock on the debit side, purchases on the debit side, and direct expenses on the debit side. While as on your credit side, we normally try to take sales and closing stock. I still have included another 2 points, the purchase returns and the sales returns, which we will talk on our next slides to understand in details. Okay, and let's see now how does that really look like, the trading account. Okay, here again we have got a traditional format of trading account whereby it is a T-shaped, where again the earlier, like in line with what I was talking earlier of having T shape, where the left side is the debit, right side is the credit. Same way here again I'm showing it here. So whatever line items that I had spoken about in my previous slide or 2 minutes back is what I'm showing it here: the opening stock, purchases, and sales, and the closing stock. Now let's get in and get an understanding in details of of these, each of these line items. Now let's talk about the opening stock. What is an opening stock? So opening stock is nothing but when you are opening, when you are creating this trading account from period to period. So when you are starting your trading account, whatever stock that you had carried from forward from that point of time, okay, from all the stock that you carried forward from the previous time period, on the day when you are starting to consider the trading account, becomes your opening stock. Say for example, you are running a business from last 5 years and you are drawing this trading account for the 5th year. So whatever carry forward items that you will have from the year 4 will become in the opening stock for year 5. Because again, if you remember, we had spoken, trading account and profit and loss account will always be for a set period of time, not as on date. Okay, but if you are doing it for the first time for the business, okay, and the business itself did not exist before, and you have, this is the first year of your business and you are also drawing this trading account on that for the first year of the business, then your opening stock will always be 0. Okay, so what all things that can be considered in your opening stock? Supposing you are into a business of merchandising. Okay, so let's take an example of maybe you can say you are into a clothes industry or a kirana store. Okay, then whatever items or the clothes that you have carried forward from your previous year to sell, because you are just a trader of the clothes. Okay, you just buy it and sell it, so you are just a trader. So that is why all the completely stitched dresses or the clothes that you have in your stock will be your opening stock. Okay, but the same cloth, if I'm saying that if a cloth manufacturer is there, okay, cloth he stitches, he manufactures and he stitches and again he sells, then for him the cloth becomes the finished good. So for, but again it can be included in the opening stock, because in the opening stock we can categorize the items into 3 parts. One will be your raw material, one will be your work in progress, and one will be your finished goods. So when you are a merchandising business, then everything more or less will be your finished good. But in the manufacturing industry, when you are in, then most probably you will have your opening stock. Okay, let's again, if I want to go back to my clothes example, then For the manufacturing industry, cotton will become his opening stock of raw material, and the half stitched clothes will become the work in progress, and the fully stitched clothes will become his finished goods. But no matter, all these things will form part of your opening stock. Now let's see what is purchases and purchase returns. So to continue your business, it's not only opening stock, right? So you have an opening stock and you cannot survive your business only with that opening stock. You will keep on buying some items to increase your business, to have your more finished goods. So whatever purchases that you would have made during that period of time will be forming part of your purchases. Okay. Again, this can be also be classified again further the raw material, work in progress, that way, but more or less it will be a raw material. You generally don't buy, because you are into manufacturing. If you are into your manufacturing industry, then probably you will buy the raw material. But if you are into the merchandising business, the clothes industry is what in our first example, then probably the purchases will be a finished goods only. Okay, now what is this, the less purchases is what I'm showing it here. So less purchases means, supposing you have ordered some, you are into merchandising business and you ordered some stock. Okay, like if you go to your stores, if you understand, Dashara stock, Diwali stock, New Year stock, right? These shops will keep telling you New Year stock, this stock, that stock, and all offers will be coming. They will be off giving you few offers and all. Supposing I am into a merchandising business, into a cloth store, and I have my opening stock, and my festival season is coming up, and I bought new stock, and within that new stock I found there were few damages. Okay, and I have an agreement with the manufacturer saying that if there are any damages to the product or these clothes, then I will be returning that. So in this case, that's an example that I have taken. I have bought some items of 2 lakhs, but I've got an item of purchases, which the items that I bought, which I'm finding is in a damaged state. So what I'm trying to return that to the manufacturer. So what I'm doing is, here I'm trying to show it as a net of impact. So that is why I'm saying my purchases are only 1 lakh, because I'm removing the 10,000 rupees from the 2 lakhs, because I'll be returning the 10,000 to the manufacturer. So this is one way of showing it. So this is the net impact show. But there is the other way of showing it is, you can show the entire 2 lakhs as your purchases on your debit side, and the purchase returns of 10,000 on your credit side. So whatever be the situation, your net impact will be 1,90,000 on your debit side. Okay, so it's your choice, but in general, people in accounting world, people prefer to follow, to show it as a net effect for purchases. Okay, now going to my direct expenses. What is this direct expense? Direct expenses are shown separately in the trading account, because direct expenses are those expenses which you can directly attribute to the purchase of the goods, or to bring that purchase, the items that you would have bought, to make it in a saleable condition. Okay, whatever expenses that you will incur, that can be your freight, that can be your customs insurance, that can be your wages, that can be your factory expenses. Supposing you are into a manufacturing industry, we are relating back to my earlier example. So whatever expenses that you would be incurring to bring your raw material, that's right, you would have paid some freight to bring your raw material, that can be your direct expenses. You would have paid some customs insurances, customs and insurance fees, that can be your direct expenses. You would have paid the wages to the workers who would be stitching those clothes, that can be your wages. Similarly, all the expenses that you can directly relate to the item to make it in a saleable condition will become your direct expenses. Okay, so on a high level basis, these are the items that we normally consider on your debit side of a trading account. Now what are the items that we consider on your credit side of the trading account? So on your credit side, we take the sales, the total sales. Okay, no matter whether it is cash sale or credit sale, it will be your total sales that we would have done. Okay, and similarly, similar to your purchase returns, we also have another item of your sales return, which is basically whatever sales that you would have made, and the customer was not satisfied with that, and we had an agreement with the customer saying that, if you do not like it, return it. Okay, like we normally do with our normal day-to-day purchases. right? So these are the sales returns that have come back to our business back because of the damages or the customer dissatisfaction, or there can be other reasons as well. Okay, so if you are trying to if you see, these two transactions, the purchase returns and the sales returns, are two sides of the same coin. So what I am returning as a sales return can be a purchase return for the other side, right? Or the purchase return can be the sales return for the other party, right? Hope this is clear to everyone. Now there is this closing stock. So this is one of the more important items that we must talk in details, but we will talk in details in later part of time. But always consider, keep in mind, whatever you could not sell, irrespective of your finished goods or raw material or work in progress, all of that item that was not sold out and left in stock will be your closing stock. But the aspect that I want to highlight in this closing stock is the closing stock is always valued at the lower of cost or the market price. Okay, whether it is in trading account or whether it is in balance sheet. Closing stock normally you will find it in trading account and the balance sheet, right? But irrespective of the place you are recording this transaction, this item, it has to be valued, it has to be recorded at the lower of your cost or the market price. Lower of the cost and market price, by that what I mean, while you are buying this raw material, okay, supposing you are into the, again going back to my earlier examples of manufacturing industry, supposing you have bought some raw material at 100, okay, particularly at 100 rupees when you had bought that during the course of your business. But while you are closing your books and you are drawing this trading account, on that day the raw material price is not 100 but 95. Then you need to record the transaction at 95 and not 100. Okay, always keep this principle in mind. Closing stock is always valued at lower of cost or market price. Okay, so now this is the traditional format is what I had shown you on the first table, and there is another format that I am showing on the right side, which is a here. This is the another format where we are showing it as a vertical shape. Okay, this is more of a modern approach because in the modern accounting people are more preferring to go with this vertical shape. Again, we have the same items here, okay, but we just have that, uh, the numbers are different because we have taken the different the lines appearance will be different, numbers will also be looking different because the shape and presentation is different on that, but everything remains the same on those two sides. It's only the difference between how you show this, either on the traditional format of T shape or on the vertical format on the modern accounting, basically to say. Now, after we have completed our drawing of trading account, there are a few entries that we normally try to enter. Okay, the journal entries. So the first item on your debit side is your trading account, just to close out those accounts from your trading account. Okay, so we will debit the trading account and we'll credit the opening stock and the purchases, the net effect and the direct expenses. Now this is basically relating back to the trading account journal entries, what we have already drawn on the trading account. Similarly, on the credit side, we will take it as a sales account debit to closing stock account debit to trading account. Okay, these are basically on the journal format is what I'm showing the trading account. Okay, now the gross profit, the trading account debited to profit and loss account, because as I told you, gross profit is the starting point. From there we will move to P&L account to understand the net profit, then again we'll move it to balance sheet, right? So here if the trading account includes your gross profit, then the transaction will be trading account debited to profit and loss account. But if it is in the other way, okay, if you are incurring a loss as a gross loss, then this entry will be reversed, so which will be basically profit and loss account debited to trading account. Okay, moving further, let's understand the profit and loss account. So after we have completed and we have ascertained our gross profit, in our previous last journal entry we said we are moving that gross profit or gross loss to the profit and loss account. right? So that is what I'm showing it here. The profit and loss account is nothing but a report of expense of an accounting period. Okay, revenue and expense. So it's as I said, it's very much similar to your trading account. That's why even sometimes we call it call the trading account as a junior P&L. Okay, now getting more some more details onto this. So how does this profit and loss account looks like? Again, coming back to the same old story of your T-shaped format. Here as well, we can also draw it on the vertical format which we had seen it in the trading account. Okay, here this is the T-shape is the traditional format, and on the vertical is the modern accounting format. Okay, here what are the additional items apart from the items that we had taken on the trading account is what we are going to discuss now. Let's understand by line item what they are. Okay, okay, now let's go into management. Again, I'm trying to, before we get into more details, I'm trying to highlight another point. This account actually shows the net income in accordance with the principles. Okay, always keep in mind, I have been talking throughout my sessions that always keep in mind whatever principles that we had spoken, whatever accounting concepts that we had spoken, and the golden rules of accounts. Okay, if you keep all that in mind, it becomes very easy to understand. So all these books of accounts, they always completely follow that principles. Okay, again, this P&L follows that same principles. Now let's understand the management expenses. What are these management expenses? Management expenses, as the line subline items that I'm showing here are very self-explanatory, whereby I'm showing all these salaries, office rents, insurance, audit fees, which are not directly associated to the your final product or to make the product saleable, are becomes your management expenses, basically to say, or the indirect expenses. Okay, here we are showing it as salaries, but in the trading account we had shown it as wages, because those are also in one form of a salary, but that were directly attributable to the product. But here, because they are the, probably it's the back end staff, okay, who manages your customer sales, or who manages the advertisements, who manage the accounts, the salaries of those peoples will be considered as management expenses. Similarly, the office rent, insurance, audit fees, these all kind of postages, insurance, or the legal charges, or the electricity charges, for that building or the offices that we would have spent, or probably the telephone charges, or maybe the printing and stationery expenses, which are basically to say are the indirect expenses. Those all will form part of your management expenses. Now getting into the maintenance and expenses. Supposing you are in a manufacturing industry, okay, you will have your assets or the machinery, right? And the expenses that you would have made for maintenance. Okay, you have taken an AMC for the maintenance, or there was a breakdown of the of the machinery. So if it can be directly attributable to the machinery and the product, then that can directly go into a trading account. If not, then it will form part of your profit and loss account. Okay, and the next item that we normally have is the selling and distribution expenses. So what is the selling and distribution expenses? You have a business, and how do we sell it? How do we advertise it? Right, you incur some expenses to advertise your business, right? Otherwise, how is that people will get to know? For us, even for a similar small kirana store, okay, what is that? You normally try to have a hoarding, okay, in front of your store, and you also try to sometimes say, give some pamphlets, distribute some pamphlets to understand, to increase your appearance, or to reach to more people, right? So similarly, for bigger organizations, they will specifically have some budgets, and they normally they are quite big, and those are being counted as a selling and distribution expenses, because maybe the company itself would be incurring, say for example, the company is established in Bangalore, but the product would be going to Delhi, right? So they would be incurring some distribution expenses because they will be manufacturing, they will be preparing the product in a final condition, then again they will send it, they will consign it to Delhi so that the product will be sold it in Delhi market. Right, those are the distribution expenses. Okay, so those are the items that we normally try to consider in your selling and distribution expenses. Now the other two small items that you can notice here is, the bad debts and the provision for bad debts. Okay, bad debts, I guess you, by the name you can understand, you all the expenses on credits that you would have made, all the sale that you would have made out on credit, and you are not in a situation and you have a very certainty that you are not likely to recover that amount, then that is what you are saying, that you are lost that amount. So that is what is also we are trying to categorize it under the selling and distribution account, and we are trying to take that hit of that particular bad debts. Again, in line to that, we also have another line item which says that, provision for bad debts. So what is this provision for bad debts? Provision for bad debts is nothing but in conjugation with the concept of prudence. When we were talking about the concepts of accounting, if you remember, the last concept that we had spoken was the concept of prudence, right? That is the concept that we are trying to uh, implement here. So what we are trying to say, if there is a foreseen loss that we are likely to incur, then we need to consider that in our books of accounts. Okay, and for that we are creating some provision. So normally we have been seeing, so in reality we saw there is a bad debt that we incurred for this financial year as 800. So and similarly we are also estimating that probably there could be some few more bad debts that are likely to come. Okay, so we are not waiting till the bad debt to occur, but we are creating a provision in this month or in this fiscal year itself. That is the provision for bad debts. Okay, similarly, the financial expenses, what could be the financial expenses? Financial expenses probably, like, you made a credit sale and the person is giving you in check. So you are going to the bank and depositing the check, and the banker is charging you to some amount to encash that check. So those can be your bank charges, right? Those kind of financial expenses will also be there, so which is what we are incurring it in the bank charges. Now now the other items that I've shown it here is the discount received, commission received, bank interest, dividend. By name they are very self-explanatory, so I don't think I need to give more examples on that. But I believe you understand this, by bank interest. Say for example, you have some deposits that are made into the bank and you are earning, and that amount is completely related to your business, not your personal amount. Then whatever interest that you are incurring, you can still take that in interest income into your business, and that becomes your bank interest income. Okay, and you have made some investments on the name of the organization or the on the name of the entity. Okay, and you are receiving some shares, some dividends on those shares, so that can be your business income as well. It may not be a normal recurring business income, but that can form part of your profit and loss account. Okay, and I'm showing another item as an abnormal gains, and on the left side also you will see one more item as an abnormal losses. What is this abnormal gain and what is this abnormal loss? Anything which is related to business but not directly related to business. Okay, supposing you are into a manufacturing business and you have used machinery items into your business to manufacturing your final goods. Okay, and there is a technology upgrade and you are trying to upgrade to a higher technology equipment, and you are going to buy that. Okay, and to buy that, what you are doing is, if you are trying to buy that, then you are thinking that, okay, if I'm buying that, then no point of keeping the old machinery, because anyways I'll be getting the high tech machinery, so let me sell this. And you are selling that item to the outside market. Okay, whatever gain or loss that you will be making on that particular machinery will become your abnormal gain, because that is not a gain that you have received due to your normal course of business, but an outside of your normal course of business is what you have made that profit. Okay, that is what we are trying to say, that abnormal gain. So if you made a loss on that, then that we will show it on the debit side, and that will be your abnormal loss. Okay, you are trying to Say for example, you have a motorbike. Okay, you have a small business and you have a motorbike. Okay, and you are properly using and completely using for that business, and you are selling that motorbike now. If at all you have made any profit of that on that, then it becomes a abnormal gain, and if you have made any loss on that, then it becomes your abnormal losses. There are more complications and more detailed concepts that we need to understand to ascertain whether it is a gain or loss, because we have to understand the net book value, fair market value, all that, but we will try to see that on the later part. But for now, on the format side and on an overall basis, if we want to understand, that's how we try to record our abnormal gains and abnormal losses. Okay, again, if you remember on the same slide, I have spoken on the second point. This follows the principles, accounting principle. So another point that we need to keep in mind is, if at all you have made some payments, okay, for your future period of business, say supposing telephone charges that we were talking about, okay, or the office rent, which I have on the second line that you see, or the two salaries afterwards, we see that, two office rent. So in the office rent, every month we pay rent, but supposing in this month we had some higher revenue, higher profit on our business, and we entered into an agreement with the owner of the property, and we said, okay, we are trying, we will what we'll do is we'll go ahead and pay you advance rent for the next 6 months. Okay, and we will no more be paying you on a monthly basis. Then should we record that on completely the entire, because I am having 5,000 per month as a rent, and I am paying 30,000 for the next 6 months. So should I take the 30,000 as a one-time hit? Should I or not? That's the question. If at all I have to go in accordance to the principles of accounting, then what does it say? It says matching concept. There is a concept called matching concept, right? We need to match our expenses and revenue, right? And periodicity concept. There are so many concepts that we had spoken earlier, so we have to bring back all those concepts into this into play and understand whether we should take that hit or not. Ideally you should not. Okay, we need to defer that amount into the balance sheet, because you have paid an amount. Okay, that's an asset, right, for the future period. For you have paid higher amount for the future period for which you are going to receive the services, or you are going to use that property. So that's why we will, and that item does not belong to this particular financial year that we are doing this profit and loss account. They belong to the future period. So that's why we do not take that hit of that the entire amount that we have made. Rather, we will make it as a prepaid account, and we will push that amount to the balance sheet and amortize it over the period of time, as and when the amount is due, as and when the amount is due for recognition. Similarly, if there is an amount, if supposing the same office rent you are saying, for some reason we could not pay that amount to the property owner. Okay, just because we have not paid, do we not recognize that amount? Do we say that, we have not paid, so should I increase my profit by another 5,000 just not to show this 5,000, saying that, I am not, because I have not paid it, I should not show it, right? But if I'm going back to my accounting concepts, then I need to create an accrual for this office rent. I will say that, nominally I have, in principles of nominal, I have already paid this 5,000, but in form of cash I will pay later. So we will create a provision for this and say that, we have paid this office rent, but in reality we will pay it later, but we are taking that expense hit into this particular financial year, because that expense belongs to this financial year. Okay, similarly there are so many nitty-gritties of the accounting concepts that we will learn one by one throughout the course of our sessions. Okay, hope this was helpful, and hope this clarifies a lot of things. Please subscribe to my channel and press the bell icon to get any further notification for any future videos uploads. Okay, thank you guys, thanks a lot.